Hello everyone! Today, in our course, The Development of Digital Currencies, we will cover Section 5.3, the Regulation Philosophy of Digital Currencies. The rise of digital currencies is reshaping the traditional financial ecosystem. The evolution of their regulatory philosophy is not a constraint on technological innovation, but is the core logic for building a credible, robust, and inclusive digital financial infrastructure. This section will systematically explain the underlying rationale of digital currencies regulation and reveal their strategic value in reconciling technological freedom with systemic risks. In this lesson, we will mainly cover the following topics. Upon completing this section, you will be able to 1. Deconstruct the dynamic balancing mechanism through which regulation suppresses financial disintermediation and abnormal capital flows. 2. Deconstruct the dynamic balancing mechanism through which regulation suppresses financial disintermediation and abnormal capital flows. 3. Evaluate how post-quantum encryption and tiered privacy design reinforce the cornerstone of technical trust. 4. Design a regulatory collaboration framework that aligns with the mutual recognition of international standards and carbon neutrality development goals. First, let's explore the first important aspect of digital currencies, regulatory philosophy, the concept of dynamic balance. The core of this concept lies in finding the optimal balance between innovation and stability. 1. Credit market stabilizer. The large-scale application of central bank digital currency, CBDC, may trigger a migration of commercial bank deposits, weakening creation capacity of traditional credit. Empirical research from the Bank for International Settlements, BIS, shows that a CBDC penetration rate exceeding 30% will lead to a contraction of bank net interest margins by more than 60 basis points. The concept of dynamic balance requires regulation to implement buffering through dual-track tools, tiered holding controls. For example, the digital personal wallet upper limit of 100,000 yuan, interest rate gradient design, zero interest for small transactions, while negative interest for large assets, thereby slowing the deposit transfer speed and maintaining the functional integrity of the credit market. 2. Safeguarding monetary policy transmission. The zero lower bound on interest rates for digital currencies could hinder the implementation of negative interest rate policies. The Swedish Riksbank's e-krona experiment introduced a technical balance deduction mechanism. When the policy rate falls below a threshold, the system automatically reduces wallet balances proportionally. This mechanism relies on the enforcement power of the regulatory framework to ensure the effectiveness of monetary policy transmission in a digital context. 3. Gatekeeper for cross-border capital flows. International Monetary Fund (IMF) warnings indicate that unregulated stablecoins could cause a 15% surge of annual capital outflows from emerging markets. The concept of dynamic balance requires establishing a sovereign currency substitution, early warning system, monitoring in real time the share of foreign CBDC in reserves, sandbox penetration limits. For example, the EU stipulates a €1,000 upper limit for single transactions in non-Euro CBDC, forming a regulatory shock absorber for abnormal capital flows. After understanding the concept of dynamic balance, let's now explore the concept of legal piercing. The core of this concept lies in achieving compliance reconstruction within a decentralized environment. 1. Standardization of judicial rights recognition. The cross-border nature of digital currencies leads to conflicts in legal jurisdiction. The 2023 FTX bankruptcy case involved 1.2 million creditors due to differences in how countries define digital asset ownership. China's civil code defines it as virtual property, while some US states classify it as money. The liquidation process stalled for over 18 months. The concept of legal piercing requires one unified ownership rules. The private key holder is the legal owner. 2. Transnational judicial collaboration chains, establishing multi-jurisdictional joint liquidation courts to resolve the dilemma of sovereign vacuum. 2. DeFi crime governance. Decentralized finance has become a high-incidence area for money laundering. In 2024, the volume of global money laundering using mixers exceeded $12 billion. Regulation needs to implement 1. Mandatory on-chain tracing, integrating tracking tools like Chainalysis on trading platforms. 2. Protocol liability piercing the EU's transfer of funds regulation requires DeFi platforms to perform KYC obligations, achieving targeted strikes against algorithmic crime. 3. Endowing smart contracts with validity. The DAO incident exposed the lack of legal remedies for code vulnerabilities. Innovative regulatory concepts include 1. On-chain arbitration mechanisms. Ethereum's Claro system supports forked execution of disputed contracts. Legal mandating of code audits. Singapore mandates that financial smart contracts pass CertiK certification, bringing decentralized protocols into the rule of law. After discussing the concept of legal piercing, let's analyze the concept of technological governance. The core of this concept lies in achieving paradigm innovation between security and privacy. 1. Quantum threat defense. The current elliptic curve digital signature algorithm, ECDSA, faces the risk of being broken by Shor's quantum algorithm. Technological governance requires 1. A post-quantum migration timetable. US NIST directives require transition to lattice-based cryptography by 2030. 2. Embedded application of national cryptographic algorithms. China's digital yuan hardware wallets use SM9 as a mandate for end-to-end encryption, building an intergenerational security barrier in cryptography. 2. Controllable privacy design. Regulation must seek balance between anonymity demands and financial control. 1. CBDC tiered privacy architecture. Sweden's e-krona uses blind signatures for anonymity in small transactions, identity linkage for large transactions. 2. Zero-knowledge proof. Regulatory interfaces, law enforcement accesses specific transaction flows with a judicial order, avoiding the dual extremes of comprehensive surveillance and privacy abuse. 3. Practices of digital inclusiveness. Approximately 2.7 billion people worldwide are excluded from the digital financial system due to the technological divide. Technological governance pathways include 1. Mandatory offline payment coverage. India requires all POS terminals to support NFC offline transactions. 2. Key escrow relief systems. Japan authorizes banks to custody private keys when biometric authentication fails, Achieving technological inclusiveness. Class. After understanding the concept of technological governance, we come to the last one, concept of global synergy. The core of this concept lies in achieving rule integration across sovereign boundaries. 1. Sharing network of regulatory information. The IMF-led Global CBDC Data Exchange Platform focuses on 3 core areas. 1. Real-time monitoring of cross-border CBDC flows. 2. Dynamic sharing of mixer protocol blacklists. 3. Early warning for quantum computing breakthroughs, forming a hub for joint risk prevention and control. 2. Mutual recognition system for technical standards. Regulatory fragmentation can easily trigger arbitrage so that the synergy concept requires 1. Standardization of interoperability protocols. ISO 2002228 standardizes CBDC system architecture. Sustainable development constraints. The EU excludes Bitcoin POW mining from its green finance taxonomy, driving the unification of technological evolution and ecological responsibility. Class. Through this section, we have learned that the essence of digital currencies regulatory philosophy is to construct a 4-dimensional dynamic governance framework encompassing technological innovation, system stability, rights protection, international synergy. This paradigm balances efficiency and security, guiding digital finance towards an inclusive and sustainable evolution. Regulators need both legal literacy and technical insight to fortify the moat of economic civilization. Finally, please complete the following exercises. That's the end of today's lesson. See you next time.